part 3, chapter 8. Now we're going to look at the perpetual system. We're going to look at costing and journal entries for FIFO, LIFO, and weighted average. Again, the thing to remember when we're recording using a perpetual system, we have to figure out cost of goods sold every single time we make a sale, so there's going to be two sets of entries. Now, we also have cost flow assumptions. We have FIFO, which is the first in is the first out, which means that's how the costs move through inventory, which is closely associated with normally how inventory flows. LIFO, we're saying that the most recent cost is the cost that should be transferred at the point of sale. And weighted average always runs in between, and what we're going to do at every single time we make a sale, we're going to come up with an average cost, and we're going to use that to assign for cost of goods sold. Here is an example, and in this example we care about when the sales were made because that's going to affect our cost of goods sold for LIFO and weighted average. For FIFO, it doesn't matter whether you use perpetual or periodic, you're always going to get the same answer because you always go back to the oldest units when you transfer out the costs. So, again, the first thing I like to figure out is my total cost of goods available for sale, total units available for sale, and ending inventory. So, I go through and I figure out my total cost of goods available for sale and my total units available for sale. I then figure out my total sales price based on selling 4,700 units, and now I can figure out how many units are going to be in ending inventory. And again, what we're trying to price is we're trying to allocate that total cost of goods available for sale between units sold and ending inventory. Now I'm going to walk you through the process of how you do it. Now I like to set up this format and I cross out as I go. So again, since this is FIFO, first in is the first out, we go back to the oldest units first, and we sold 2,500 units in total. Remember, you can only price based on how many units you have at that cost. So in this case, we can only take 1,000 at 12, which means we still have to price the other 1,500. So now we're going to be left with 500, but cost of goods sold is going to get 1,500 at 18. And then when we sell our 2,200 units, we're going to take 500 that was left over because we go to the oldest costs. And then the balance is going to come out of our most recent purchase. And now we know our total cost of goods sold. We know our ending inventory is going to be 1,300 times 23. We add those up. We get 117, which is our total cost of goods available for sale. And now we can figure out our gross profit. Again, whether you use periodic or perpetual, you're always going to get the same answer when you use FIFO because we're always going back to the oldest units. So now let's take a look at what would those journal entries look like every single time we make a sale. Well, our first sale of 2,500, we would book the sale and we book our cost of goods sold. The second sale, we would book our sales and again book our cost of goods sold. So since we're doing perpetual, anytime we move inventory, it's going to come out of the inventory account. Now, what would this look like based on your homework and how they present it? This is the way it would look, and again, if you notice, we end up with the same number of units available. We end up the same units sold in that last bottom line and ending inventory. Now let's take a look at the same problem using LIFO with perpetual. So now what we have to do is, when we sell the 2,500, we have to take 2,000 out at 18 and 500 out at 12. When we sell the 2,200, we have to take it all out of that 3,000, leaving us 800, which when you add with the 500 still gives us 1,300 in ending inventory. And now we have our cost of goods sold. Our ending inventory is going to be 500 times 12 and 800 times 23. That equals our 117. And now we have a new cost of goods sold. A new gross profit. Now, if you notice, it's left under LIFO. Now, here are our journal entries. We're going to now, it's same journal entries, it's just the cost of goods sold is going to be higher because we're taking our most recent costs, and this is only true if prices are rising. Same problem, but using the format that you use in your homework. This is kind of help you out so you can see the relationships. Again, we had the 3 columns. The cost of goods available for sale has to equal our total units plus total cost. Cost of goods sold under LIFO, and that should be perpetual. I know it says periodic, but this is done based on perpetual, but you would have got the same answer. Now let's take a look at this using our moving average. Let's go back to this. No, you wouldn't have gotten your same answer. So let me fix this. Okay, what I've done on this one is I changed those titles so it doesn't look confusing, but this is what it looks like. Cost of goods sold, perpetual LIFO, ending inventory, perpetual LIFO. So that's the same problem, and it's done just like it is in your homework. So I want to get you an idea of the format, and you can relate it to the way I did it, or you can do it the way I did it and then fill it out here. Now the last one we're going to do is the moving average under perpetual. Okay, so for this one, what we're going to do is we're going to take our beginning inventory, we're going to add our purchases up to the point of sale, and we're going to calculate a average cost, and that is what we're going to use to figure out cost of goods sold at that sale of 2,500 units. Now the remaining 500 is going to be priced at that average cost. We're going to add our new purchase, we're going to come up with a new average cost, and we're going to take that, remember you have to recalculate each time, time the units sold, and now we get our cost of goods sold associated with those 4,700 units using weighted average perpetual. Units in ending inventory are going to be $1,300 times that last average price. Total cost of goods sold is going to be $88,400. Again, we have our 117, which we always want a total. And now we have a gross profit of $59,200. Now, what do our journal entries look like using this method? Well, our accounts receivable is the same. There's our weighted average price. Again, the next sale, our sales are going to be the same, but we're going to have a different number for our cost of goods sold. Now what I've also included is that same problem using the format used in your homework. And as you can see, get the same answers for both of these. So I try to give you a way of how I work them out, and then I also want you to be able to understand how it's done in your homework. And thank you, and that concludes part 3.